Most retirement plans don't accurately reflect what retirement will actually look like. And this causes many people to work longer than they need to save more than they need to, and then to spend less because they're afraid of running out of money. We've been helping people retire for the last 16 years at Streamline, and we've seen hundreds of retirement plans. And then we see what actually happens in retirement. There's a lot of planning software and tools available to us, and they typically project spending increasing every year with inflation. Makes sense because we want to keep up with inflation and as things get more and more expensive over time. But JP Morgan did a study of over 280,000 retirees, and it revealed the truth about retirement spending. So in this video, I want to simplify it down to the three major insights that's going to help you get closer to what retirement will actually look like, how much to save, and then optimal withdrawal strategies so that you can make the best possible decisions for your retirement. And if I haven't met you yet, I'm Dave Zoller. I own a retirement planning firm with Tim, Luke, and Sean, and we help clients across the United States. Now, let's get into the first discovery from JP Morgan's research that shows a different picture than what most people think happens in retirement. And that is, retirement spending doesn't increase as much as we're led to believe it does. It actually decreases. It follows a predictable curve that peaks in your late 40s and early 50s, and then gradually declines throughout retirement. Now, you might be thinking, what about healthcare costs? Those go up, don't they? Well, you're right. And you could see it here in this line increasing, but the decrease in travel and entertainment and transportation, some of the other things, that more than offsets those healthcare increases. Now, you might be asking, what about inflation? Well, everything does get more expensive over time. That's true, and here's a picture of it. But what this chart shows is that it's not an increase of the standard 3% per year, which is the common planning scenario. But the real world data shows that it's only a 1.65% annual increase. And if that's true, that means you might need 20 to 25% less savings than traditional models suggest. And something important here that JP Morgan identified is there's 6 types of retirement spenders, and knowing which one you are, it's going to make retirement planning a lot easier. So I'll get to those soon, but I wanted to get to this next big discovery that was found because it impacts over 50% of all retirees. And that is more than half of all households don't retire all at once. They transition gradually into partial retirement, which means that those either one of the spouse continues to work, or they do a partial retirement where they're still earning some income and then also starting to draw from retirement accounts at the same time. And the interesting thing about partial retirees is they actually spend more compared to those who retire completely. So here's the chart. It shows about $5,000 per year more than a fully retired household with the same income. So the takeaway here is, if you're considering partial retirement, budget for higher expenses during that early transition period. And let me pull it up once more here. And we could see this sort of spending surge for these partial retirees. So that's specifically this phase, that'll be an important one to plan for because it's not the same as a person who's going fully into retirement. And I'd be interested to hear, if you've already retired, please share your experience with how the first few years of retirement were. Did spending increase for you? A lot of times I hear that the comments have been really helpful for people who are getting to this stage and as they're planning things out. So if you've got anything to add, please do. Now, the next big discovery is that 60% of retirees experience major spending fluctuation in the first few years of retirement. So we kind of looked at the spike that happens to many, but essentially they experience quite a bit of volatility in their spending. It could be up or down, and I'll show you some stats here. In that early retirement, there's more volatility before things start to smooth out. And this is where JP Morgan identified the 6 different spending patterns. And most retirees, they don't follow the steady, predictable path that traditional planning or financial planning assumes. Here's what it looks like. The big takeaway from this is that only 18% were steady Eddie spenders in retirement, meaning that 82% experienced some form of spending change. But here's why this is really important. This volatility in spending, that can increase the sequence of returns risk for you specifically. Because if you overspend in early retirement during a market downturn, especially, you could seriously damage your portfolio's long-term viability. And that's why we often create bear market protection plans for our clients. As one of the scenarios for every client at Streamline Financial. And here's the actionable advice. Build flexibility into your retirement spending plan, especially in those first few years of retirement, and consider creating a bucket strategy. I'll pull up an example here for the bucket strategy, but as I do, let me know if this is helpful so far by just clicking the like button. So here's the idea behind the buckets. It's having different asset classes with each a defined purpose. So in simple terms, it's conservative, moderate, and growth buckets. And to help prepare for that sequence of returns risk or for volatile markets early in retirement, the goal will be to have a certain number of years of withdrawals in this conservative bucket that won't be impacted by bad economy or bad markets. And it allows you to not have to sell investments to provide for income during those rocky periods. That's where people really get into trouble, when things are down, being forced to sell to provide for their income. And if you want to learn more about how to actually implement the bucket strategy as part of your plan, I recorded another video that's going to pop up on the screen pretty soon in just a few seconds. But the big takeaway here is traditional retirement planning. It's based on assumptions that might not match reality. Most retirees don't increase spending every year with inflation, and many don't retire all at once. And the majority experience significant spending volatility, especially early in retirement. That's why at Streamline Financial, we believe that retirement planning isn't just about accumulating assets. It's about creating that life strategy that gives you confidence to enjoy the money that you've worked so hard to save. If this video was helpful, please click the like button so that hopefully YouTube recommends it to someone else. And then check out this video on the bucket strategy here. I'll see you there. Take care.